not paying taxes may be one of the most patriotic things a person can do. I mean, one of the catalysts for the founding of the United States was a reaction to what was seen as unfair taxation. Now, I say all that sort of tongue-in-cheek, but there is a growing frustration with our tax system and how those tax dollars are used. I think it's fair to say that most people hate paying taxes or at a bare minimum dislike writing that check to the IRS. A huge chunk of your hard-earned money is spent on things you may not necessarily agree with. You may feel like you have little say in how those dollars are used. On top of that, the government often spends above and beyond what it collects in taxes, which leads to inflation, which devalues the dollars that you get to keep after paying taxes. So it's very frustrating, to say the least. I get it. And I think that frustration has led to the temptation for people to get a bit more aggressive with tax strategies, which has also paved the way for these tax gurus on social media gaining big followings by promising ways to beat the system. And it's not even just tax-specific accounts, but financial or even real estate influencers promoting very aggressive tax strategies that can and do put people in sort of a dicey financial situation. So I'm going to go through some clips, some things to maybe watch out for. But before I get into that, I don't intend this to be me just trashing these people or, just poking fun at the ridiculousness of some of the strategies they promote, because they do post a lot of content on legitimate tax strategies. In fact, I'd say the majority of what they post and what they put out has some merit to it. Another positive to what they've done is I think they've gotten people more interested in taxes and just getting people more aware of their tax situation, which is good. It's just a portion of what they put out, the content that goes viral, ends up being more harmful than helpful and can even hurt people financially. And I don't think that is the intention at all. There are just some things that I think most people need to watch out for. Now, the biggest problem in my mind, one of the biggest problems, in some cases and not all, in the worst of cases, is that these strategies get awfully close to what we would call fraud. So Exhibit A here.
Walk it, 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 big bank roll sagging, stick Drake goes a candy, drum up hold the mallet, truck got bills and baggage, rap it, put it in traffic, stepped on off-white canvas, stack them bands and stash. You see the label, we having the favor, we buy at the bar, we risen.
So if it sounds too good to be true, it's probably because it is. Back in the late 80s, the Supreme Court established some standards for professional gamblers. It was basically, if the gambling activity is pursued full-time, it's done in good faith, with regularity, for the purpose of producing income for your livelihood, and it's not a hobby, then it can be considered a trade or business. So you'd have to prove that you do this full-time for a living, which would be tough, I think, for most people. Even if you do that, you'll have to prove that attending the Super Bowl in person was a necessary expense to support the production of that gambling income. I think both of those things would be tough to prove to the IRS. And being this blatant about it could end you up in some trouble. Another similar strategy promoted by the same guy, actually, and then I'll give him a break, is this one here.
But I still work a job. What can I do to benefit on taxes?
Okay.
And one of the best things that a W-2 earner can do is turn their hobby into a side hustle.
Turn their hobby into a side hustle.
Turn their hobby into a side hustle.
Which is basically a business that has tax deduction.
Exactly. So if you're a W-2 earner and your hobby is to travel, I will encourage you to start a travel vlog. So now every trip that you take to another state, another country, that's an ordinary and necessary business trip. Because how are you going to write a blog about traveling without traveling? So now you get to write off these trips that you're going to take, these personal trips. These are now business trips. Your hobby that you were not getting any deductions for, you might have $5,000, $10,000, $15,000 of tax deductions in this side business, which is your hobby. So now you get these $15,000 in losses. Most people don't know that you can take those losses and subtract it against the W-2 income you make at work.
So the IRS has laws in place to prevent this exact thing. They're called the hobby loss rules. You have to be engaging in the business for the purpose of making money. If you don't turn a profit in the last 3 to 5 years, the IRS could come in and disallow all of those losses. And then you end up paying more in back taxes and interest and penalties. So maybe not the best strategy, pretty much exactly the thing that caused the IRS to implement those rules. All right, and then another one here that probably gets close to the F word as you can. Let's check it out.
Never show the IRS that I'm making any money.
Okay.
When you get your first job and you're making 200 grand, your goal is to get that 200 grand to 11,000 bucks.
How do you do that?
So this is you and this is your company. The goal is to make your company broke on paper. If your company doesn't make any money, it doesn't have to pay any taxes. This is how you can legally get the money out of your company. Instead of working for your company, you work for your trust. When you set up your trust, you transfer your intellectual property into the trust. So all the money your company generates with your intellectual property has to go back to your trust. And because we set up your trust in Cyprus, you don't have to pay any income tax, corporation tax, capital gains tax, or inheritance tax. Now with the income of your trust, you can still buy all the assets that you want and benefit from them like they're yours.
All right, now I don't want to make accusations, but this sounds a lot like an abusive trust tax evasion scheme, which the IRS has a whole page on. They take it very seriously. And by the way, the Grant Cardone video was how the guy introduced the concept. I have my qualms with Grant Cardone, but he wasn't promoting this strategy in that video, just FYI. So the problem here is that if people take this kind of advice, they can end up in a lot more financial and maybe even legal trouble than they were initially. And I have a handful more that I want to go through, but there's a big difference between tax avoidance and tax evasion, and it's about 15 years in prison. I'm a huge proponent of helping people pay as little taxes as legally possible so that they can grow their wealth and provide a better life for their family. Legally is the key word there. I like to use something called the straight face test. Could you sit down across the table from an IRS agent and justify this strategy with a straight face? If the answer is no, you should probably think twice before doing it. Because in the end, it's your return. You're on the hook if this goes south. Just because it's being promoted on a big platform by a popular personality doesn't mean that it's legitimate in the eyes of the IRS. And just because your CPA opposes it doesn't mean that they work for the IRS, as we've heard quite often. Here's one example.
Not sure if your accountant's working for you or the IRS? Here's 3 ways you can tell. Number 1, when you see an idea and bring them an idea to help you save taxes, they shoot it down rather than look for ways to make it work. You want to make sure you're doing things legally in the right way. You want to come at it from an angle of how do we make it work rather than this is why it doesn't work.
By the way, I like this guy. He's got a lot of good stuff. Seems to know what he's talking about. This is just a common hook for tax videos, and it's the first one I found, so I pulled that one. It's not that they work for the IRS or they don't care in most cases. I think it's actually the opposite. They don't want to be a part of something that could potentially devastate your life and your family. And saying that they work for the IRS or a bad CPA, I think it undermines the trust of people who really do want to help. Sometimes the answer is simply, this doesn't apply to you. For example, if you're a W-2 worker with no business income, you can't write off a vehicle. Yes, your CPA should be proactive and looking for every tax mitigation opportunity available to you, and you can be aggressively strategic within the confines of the law that are in place. There are limitations to that. Now, if you hate the tax system we have, get involved in politics to change it. In the meantime, we have to play the game by their rules if we don't want to end up bankrupt or in jail. Another big problem with this Wild West approach to tax strategy is that some of the popular strategies being promoted apply to very few people. None of them who are getting their advice from social media. For example, this one.
Here's how you can avoid 100% of your income taxes every single year. We call this strategy the paper law strategy. In order to use it every single year, you have to understand the rules. The very first thing that I'm going to need you to understand is you're going to need to buy an investment property. When you buy a rental property, it could be an Airbnb or it can be a long-term rental. But as soon as you purchase the property, I want you to write off everything that's on the inside of the property. This could be appliances, bathrooms, tubs, cabinets. And when you write off everything that's inside of the property, it creates a big expense. We call this the cost segregation study. Once you do the cost segregation study, it creates a big enough loss to offset your W-2, your 1099, your stock, and your crypto income, making you tax-free. Comment below.
All right, the cost segregation study is a great strategy, but it's a one-year thing. You do a cost seg once per property. So in order to do this every year, that means buying a property every single year. Also, that property has to be big enough to produce enough losses to offset your income. Furthermore, you can only offset active income, like your W-2 income, if you're a real estate professional or doing short-term rentals. There's a loophole there, both of which have some substantial requirements around them. All that is left out of the video. And, I've had actually a client watch this video in particular and think that that meant that if they buy a property, they're not going to be paying taxes anymore. That buying a house, doing a cost seg study will wipe out their income, and then it's a recurring thing. But actually pulling off what he's promoting in the hook of this video requires some pretty serious money. But you wouldn't know that by just watching the video, which I think can lead to some disappointing results for people that attempt to implement these strategies. You also hear about strategies that just don't save you as much money as they make it seem. This one is a great example.
One of the most overlooked aspects of the Internal Revenue Code that the elite use for their benefit is the Augusta Rule, where you can rent out your personal residence for up to 14 nights, tax exempt. In fact, it's one of the only places in the Internal Revenue Code where it says, please don't tell us about your income. A lot of people hear that and think, well, why would I rent my house out to people I don't know? Well, of course you wouldn't. But if you'd made a corporate structure and put your family in that structure, well, then it's advantageous for that company in which your family resides to meet every quarter for business meetings or a conference. Where can they have that conference? At your house. And then you can charge them $400 a night. Let's say you put 6 people in there, 14 nights in a year. That's $33,600 you just made tax-free.
Now, there is some merit to this. The Augusta Rule is legitimate, but it has some strict documentation requirements. You have to charge market rate, like comparable rates to the size of the space in your area. And like you said, you're limited to 14 days per year max. For most people, the tax savings are minimal, not near the number that he said in the video for the majority of people. And this is certainly not a strategy that the elite are using to minimize their taxes. This is peanuts for them. Every time I see this strategy promoted, it's almost always exaggerating the benefits. Is it worth exploring? Absolutely. But let's just set realistic expectations. And then, of course, you have the luxury vehicle. This is probably the most common one that gets shared on social media, buying a vehicle for the write-off.
Why I bought a $70,000 truck. I bought a $70,000 truck late last year to save more than $21,000 on my taxes. I did this legally through what's known as the 179 rule. Essentially, the $70,000 counted as a legitimate business expense and lowered my business's taxable income by $70,000. This allowed me to save about $21,000 on my taxes through purchasing a qualified vehicle. And now,
all right, this right here, I think, is what encourages a lot of people to make poor financial decisions purely for the sake of taxes. And, these types of videos, I could pull up probably 100 of them. I think this is patient zero for what I call tax derangement syndrome, TDS, very serious disease where, you spend like a drunken sailor if it means paying less taxes. So go into an enormous amount of debt just to reduce your tax bill. Let's actually run through an example. So let's say you owe $100,000 in taxes. You want to get that down, so you buy a luxury vehicle for $70,000. Using the amount in his example, let's say you get a $21,000 deduction. So you brought your tax bill down to $79,000, but you had to buy a $70,000 car to do it. So now you're out $149,000 instead of just the initial $70,000 had you paid the tax bill. And you did it by buying a depreciating asset that you probably didn't even need in the first place. And now your net worth is actually lower. Now, we all want to pay as little taxes as legally possible, but you can't make tax decisions in a vacuum. You have to look at it in the context of your entire financial picture. And by the way, getting your tax bill down to zero every year has consequences, particularly when you're trying to get a loan. If the lender sees a return with barely any taxable income over the past few years, you're going to have a harder time getting a loan with favorable terms. So that's something to consider as well when you're thinking about implementing these tax strategies. And like I said, all these people have some good content, but it's difficult for the average person to understand the nuance of these tax strategies, which are often glossed over in the videos. Again, I don't think people put this stuff out there to intentionally try to put people in a bad position. I just wish there was a little more discussion on, the context and nuance of some of these strategies. And this type of content is not the majority, I would say. There are a lot of people out there putting out high quality tax content. I'll link some in the description. So the information is out there. It's just obviously the stuff that sounds exciting is the stuff that gets clicks. Part of this is probably applies to any industry, but this is just the nature of short form content. Detailed explanations don't get as many views. Nuance isn't popular. The it depends approach is just not going to go viral. But context is important, especially when we're talking about things that impact people's money. And it's kind of why I've shifted more to long form content, because I want to provide the full story. I don't want just to put out a 20-second soundbite. I want to put out content that people can actually use to make informed decisions, which requires more in-depth explanations. It's not as sexy, it's not as popular, but it's the truth. I've said it before, tax planning is powerful and it's necessary for building long-term wealth. It's where I spend probably more than half my time, but it's just one piece of the puzzle. If you let the tail wag the dog, I think that's the phrase. If you let taxes drive every decision while ignoring broader financial goals, it could end you up in a worse financial position. So before executing any of these strategies, just make sure it fits into your long-term financial objectives.